Welcome to New Frontier's quarterly update titled Markowitz and Maximizing Markets. I'm Catherine Opiella, and I'll be your moderator today. Before we get started, just a few housekeeping items to touch on. We encourage you to participate throughout the webinar by submitting questions. You can post your questions through the Q&A function at the bottom of the screen. We'll be keeping track of those throughout the program. Today's program is being recorded and will be made available on demand, which we'll notify you of via email once it becomes available. And a reminder to stay until the end of the webinar if you wish to qualify for 1 hour of CE credits. In today's webinar, we will echo the profound loss of Harry Markowitz this past quarter and explore the rising themes of big tech and artificial intelligence. We will offer our latest views and share how recent market performance has impacted portfolios and how new information is being reflected in the positioning of our portfolios. To keep things interesting, we will be posting polling questions during the program, and we will share results in real time so you can see what others are thinking. We would also appreciate if you take a very brief survey at the end. With those things covered, let's get started. Today, I am joined by Chief Investment Officer Robert Michaud and Senior Research Analyst Joy Jen. In today's agenda, we will cover Harry Markowitz and his lasting impact on our investment process. Joy will then go over our performance review and updates. Then Robert will provide us with a recap of what happened over the course of the past quarter. We'll then offer investment perspectives and insights, and we'll close off by answering your questions in a live Q&A. Again, thank you for joining us, and I will now turn it over to Robert to open it up.
All right, thanks, Catherine. So today I wanted to talk about a great man and a great friend to me, my dad, Harry Markowitz. So I love this picture. This picture has two of my favorite and most inspirational people in finance to me. And so I guess it's no surprise that I'm a little bit optimization biased in terms of how I view the world. And it's a sad event to think about Harry Markowitz and the things that you can no longer tell him. You can no longer tell him about how my son has gotten really into improving the efficiency of computer algorithms, or my daughter has decided to optimize her selection of Halloween costumes through a multi-factor model. And so, but what I can do is I can try to spend just a few minutes to help people get some of his appreciation and deep understanding of optimization. So for those of you who aren't familiar with all of Harry's many accomplishments, this started over 70 years ago with his seminal paper on portfolio theory. And just think about what the world was like before that. Before that, asset managers, investors would just think of one stock at a time. They would just try to hold every investment up to, is it a good investment? Is it something I'm not going to lose money on? And just think about it in isolation is extremely limiting. It was, they couldn't invest in too many things. And they didn't think at all about how things fit together. And one of Harry's themes is like, think harder, think deeper, and the optimization will reveal itself. And so he has a line of work which continued. He was really interested in simulations. He was interested in understanding how you could be wrong and what the future of an optimized portfolio might look like. And then, of course, he not only got the Nobel Prize in 1990 in economics for portfolio theory, but not everybody knows that the year before that, he got a John von Neumann Prize for his mathematics of optimization work. So optimization can do so much. It's really a general framework. That's how Harry thinks about it. That's how I think about it. And so what is the framework? Well, you start with what's the objective that you're trying to optimize? You think about, well, what are the decision variables? What are you trying to maximize? What's the thing that you don't want? What's the structure? And then how do you find a best solution there? And why are you doing it? Because everything should be optimized. Why would you not optimize? If you're not optimizing, then you're doing things literally worse than you could be doing things. And that's not something that Harry would ever accept. So thinking about optimization, you can think of it in sort of two parts. One is calculating the efficient frontier solutions. So this requires a very deep understanding of what the problem is, and then you have to be able to quantify it and optimize it. The other side that people don't think about as much is you need to be able to choose a solution. Harry spent a lot of work giving us the tools to build optimization. He didn't say what all the answers were. He wasn't being prescriptive. This is sometimes why people say he's not really an economist. He's not trying to value assets or anything like that. He is giving us the tools. So the other part is choosing the solution. That means that you really need to have a deep understanding of your own preferences and be able to quantify them to be able to choose which of these optimal solutions is right for you right now. And a lot of the times, people might be able to do one of these things and not the other, and quite often neither of them really. And so in that case, they shouldn't optimize. But if you have a really good understanding of your preferences, but you don't know what's optimal, then you can think about trying to choose the best fit, right? If you're shopping for something, choose something that fits. Don't worry about the price, I guess. I've never done that. If you're thinking about if you don't know yourself so well, then you can try to think about, well, what is most efficient? What's the best value out there? And this is like what my mom might do, which is she'll buy anything that's on sale. She doesn't know what she likes herself, but she knows that it's efficient and a good deal. And if you don't know either of those things, what do people do, right? There's a lot of times where people aren't aggressively optimizing, and sometimes they're right to not do that because maybe they can't have such a deep understanding. So in those cases, some of these non-optimized but very reasonable solutions are rules of thumb, like follow the herd or find someone who's an expert who you can take their advice and emulate it. Or if there's something that is a little bit more quantifiable, then think about sort of all of the good things. Imagine this is the way they did investing hundreds of years ago. Take all the good things that kind of seem reasonable and then just equally weight them. So these are non-optimized, but ways to make good decisions, but that's not what Harry was about. So just to give you a somewhat whimsical example, and I wanted to make a couple of points here. One is that efficient frontiers are personal, right? There's no one right answer for what they have to be. And to take something highly subjective and personal, I thought I could come up with an example of choosing a pet. And so let's try to quantify this. Let's think about, well, there are many different factors that might go into what's a good pet and not, and how do you weight these things? And so also, what's your objective? Well, I've decided that what I really need is more excitement in my life. And so I'm going to look to a pet to get that. But I've also decided that I'm busy and I do not want a pet that is a lot of maintenance. That's the main cost for the pet for me. And so I'm going to think about, well, how furry is it? How intelligent is it? How big is it? How messy is it? Many different factors. So this is actually a highly multidimensional problem. And then I'm going to put that into the opportunity set of what are the pets that are available to me? Cats, dogs, turtles. There's a rabid dog down the street. Maybe I could pick that up. And then plot these on the efficient frontier. And so then I probably would end up with something that it fits your intuition, which is that cats and dogs are more plausible, efficient solutions to this problem than many others. And a cat is more interesting than a turtle, and they both have the same maintenance. That still doesn't tell me whether I should get a cat or a dog. I have to really think a little harder about that. Anyway, so optimization can be applied to anything. Harry really believed that. I do too. You just have to work at it. But another reason why I admire the guy so much is because he was incredibly honest. He did a lot of work, and when it didn't always come up his way, he would mention it. But why was Harry so interested in financial portfolios? Finance is different, right? Finance is highly quantifiable. We have so much data. Wealth is fungible. It doesn't matter whether you're getting a return from a stock or a bond or something else entirely. It's all comes down to return. Also, the constraints are clear. If you have a budget constraint, if there are certain other restrictions, then these are very quantifiable. And Harry did a lot of work to say that preferences can really be approximated to just two: risk and return. For almost any type of investment problem, you can think about, are you maximizing return and minimizing risk and being as efficient in those two dimensions as you possibly can be? If you are, then for the overwhelming majority of investment problems, then somewhere on that frontier is going to be the right answer. So, and then the last thing is, he knew from the way investors behaved, from math, from understanding that the world isn't as certain as you think it might be, that the answer has to be a diversified portfolio. So knowing what the answer is going to look like, having some sort of theoretical basis there is very helpful in these types of problems. So then you can choose different types of risk measures. There might be downside risk, or that Harry was actually quite interested in. We always talk about mean and variance or standard deviation, but there are other ways to think about risk and other ways to quantify that. You can also, it's flexible on return measures as well. And again, this doesn't say what is the best stock. Harry never told us what the top of the efficient frontier or even the bottom of the efficient frontier is. He just gave us the tools to do that. So I will talk a little bit more later, of course, about our personal optimized solutions for this. And I just wanted to give you a couple of Harry's tips on life. And one is just diversification. So you think optimization sometimes gives you a specific answer, but he wants optimization to give you a very diversified answer. And the reason why he cares so much about diversification is because the future is unlikely to be like the past. Sometimes you've heard modern portfolio theory criticized, and this is people, in my opinion, misapplying his theories. And often those times are because they're using mean variance optimization on historical data, being very backward looking, ending up with a concentrated portfolio in the wrong thing, very much what you should have invested in, but not what you should be investing in, because the future is unlikely to be like the past. So you need to be even more diversified than what your portfolio might calculate. So I hope this has helped you get a little bit of appreciation for Harry. And if there are more questions, then I would happily take them. So briefly moving into our optimized portfolios, I wanted to talk about asset allocation changes. Well, there actually weren't any in the last quarter. There have been a lot over the last 12 months. One of the main themes has been the radically changing fixed income situation with changing and now inverted, much higher yield curve. And so that has led our optimal solutions to seek lower duration and take risk in other places. So we didn't rebalance last quarter, but we did rebalance near the end of the previous quarter. And that was determined by our rebalance test, which we look at every day, that we didn't need to rebalance the portfolios because a lot of times nothing too terribly unexpected happened in the last quarter from a financial markets perspective. And already the portfolio was adjusted for the inverted yield curve, and just balancing risks and accepting higher return from yield continues to be the right answer. And this, just to give you a flavor for it, is something that's a indication of how should you think about fixed income right now. I think, again, a little less duration, taking risks in other places. High yield is scary, but being able to balance that type of risk amongst many others in your portfolio when you optimize is an important part of the picture. And so with that, I think we will have a quick poll, and then we will go over to Joy for the performance review. So I went over the timeline very quickly, but which publication highlights Harry Markowitz's ideas for which he was awarded the Nobel Prize? If you had to pick one that was closest to what he got his Nobel Prize for, which one do you think it would be? So we'll see how tricky a question this is, and we will give you about 15 seconds. I, of course, like everything on this list. SimScript is if you told Harry, walked up to him and said, I have been using SimScript, he would light up so much and be your friend forever. So it looks like most of you, no one picked SimScript, that's true. That would be the last choice to take. Portfolio selection is correct. So that is the answer I was going for. Thank you. Here's Joy.
Okay, great. Thanks, Robert. And thank you again, everyone, for taking time to join us today. I'm Joy Jeff. I'm here to share with you some insights on the performance of markets, asset classes we're investing, and our portfolios for the second quarter of 2023. The second quarter was a great quarter for the global equity markets. The US market entered a tactical bull market with S&P 500 rising more than 20% from its October low, shown in the white line here on the chart. And within the quarter, S&P 500 gained 8.7%, and the rally was largely driven by a few tech companies in US that have benefited greatly from an artificial intelligence boom. I added an orange line here, which is a FEM Plus index, which is a 10 equal weighted tech companies, including Apple, Google, NVIDIA, up phenomenally 74% during this time period and up 25% this quarter long. And beyond what is in the news, in the headline, beyond what we already know, what's more to this is that the bull market wasn't limited to US. The three lines here on the chart that move so closely and hovering on top of each other are AQX US, AQX US large cap growth, and large cap value, respectively. They posted the similar impressive returns during this time period, up more than 20% as well, close to US. But in contrast to the narrow leadership in the US rally, there is a broader based rally in the international markets with both value and growth participating. And beyond the stock market rally, let's take a look at Treasury. US labor markets remained resilient. In June meeting, Fed announced signaled more rate hikes this year after holding the rate steady. As a result, market expectations shifted from anticipating rate cuts by year end to pricing in 1 to 2 more rate hikes later this year. So what's reflected here is that US Treasury yield curve shifted upwards from orange to green line, which is as of the end of last quarter. 2-year Treasury yield experienced the biggest increase of 80 basis points, reaching almost 4.9%. However, compared to the yield curve from the end of last year, which is in blue line, only the very front curve saw a significant rise from 1 month to 1 year, and the long end haven't really changed much, reflecting that long-term expectation for inflation and growth really haven't changed, but only the front end that reflect the short-term interest rate increases is more significant. And as a result, what we can see from bonds performance is that bonds had a flat or negative quarter following a robust recovery earlier in the year. US Ag bonds were down 0.9%, but still up 2.2% year to date. Long duration treasuries were down 2.5% this quarter, and it is among the worst performing bond. But remember that during the first quarter, it performed really well. It is actually the best performing bond the first quarter, and was still up year to date 4.7%. And overall, this quarter duration did not help. Credit outperformed. We have the top performers, including ultra short treasury floating rate bonds up 1.3%, short-term high yield up 1.5%, and emerging market bond up 1.6%. And I would like to highlight convertible bonds. We added the ETF to our multi-asset income portfolios late last year to diversify risk and also counterbalance the natural bias towards value and dividend in income portfolios. And convertible bonds have both bond and stock alike features. And the ETF has 40% of its underlying holding to equities in tech sector. So as you can imagine, this year, convertible bonds really benefit from growth rally and up more than 5% this quarter, more than 10% year to date. On the equity side, an overall great quarter and a great year for equities so far. Global equities up 6% this quarter and 14% year to date. relatively speaking, for the quarter, growth outperformed value, large cap beat small cap, US did better than international, and high dividend underperformed the broad markets. This is no surprise to you all that large cap growth is the best performing asset this quarter and this year. And I would like to highlight that 29% year-to-date return basically offset all the losses incurred in 2022. So this is a sharp reversal. Value and growth rotated again this year. And this is to remind us that one, it's really hard to time the rotation. And when the rotation happens, you want to make sure that portfolios are stay dynamic and have diversified exposure to both so that you can cushion the fluctuations. And then beyond the US, we, in terms of international equities performance, they have a broader rally, as I mentioned earlier, even though to a lesser degree. Europe posted a modest gain of 2.8% this quarter. Eurozone entered a recession earlier this year, and ECB raised rates for the 8th straight time. Asian Pacific went up almost 3%, helped by Japanese shares. Emerging markets were only up 2%, pulled down by weaker than expected recovery in China. In the end, alternative exposure to gold and international REITs did not help, and they were among the main detractors from portfolio performance this quarter. And that leads to our portfolio performance. Here I'm showing you net of fee performance for global core, tech sensitive, and multi-asset income for different time periods, including quarter to end to 10-year performance. So great quarter for our portfolios, and you can access performance data through the performance sheets currently shared in the chat box and also on our New Frontier website. A great quarter and great year, and especially 1 year performance. The thing I want to point out to you is that, one thing I've been seeing every quarter is that when you evaluate performance, you want to make sure that your performance, is in line with the target risk, in line with their expectation, and our portfolios have been consistently delivering that with stability. I do notice one of the pre-submitted questions asking about our growth position and how we allocate to growth, and I'll definitely address that in Q&A section. And here I do want to point out that it is important to remember that we do not try to time value growth rotation. Instead, we think of growth and value as an effective way to segment US markets into large, small value growth, and they have different risk return characteristics. And the reason I bring this up is this quarter really, portfolio performance are coming a lot of performance is coming from growth, and that's a big part of the performance this quarter. For multi-asset income portfolios, our income portfolios performed positively this quarter, even though high dividend equities actually underperformed markets and turning negative. And the reason for that is our portfolios benefit from a wide range of high dividend ETFs across various markets, including emerging market high dividend and US market cap weighted high dividend. And the yield provided currently is about 5%. And with that, this is all for the performance, and I think markets remain strong, and people have questions about what about recession? Have markets fully incorporated the risk of recession? And here comes the second poll. Do you think there will be a recession in the next 12 months? Recession fears are overblown. The Fed's 50-50 sounds about right to me, so there may or may not be a recession. Or the market expect a slowdown, and I do too. Or we're already in a recession. And let's take 5 seconds to answer the question. Okay, it looks like 40% people think markets backwards and the rotation, they do too. And 30% think there may or may not be a recession. And I would like to bring Robert back to the discussion. Judging from this quarter and year-to-date performance, markets seem to be really optimistic about the future growth, and AI definitely gets something to be excited about. So Robert, what do you think? What's your outlook on recession?
Well, and recession seems still to be a risk. I'm actually surprised that it's quite as big a risk according to the poll as we see here. And if you think about markets, if you think about what's been going on, it seems like there's been a much more optimistic shift in the mood. And so we can talk a little bit about why that might be in the next section and in questions.
Great. So with that, all yours, Robert.
Thank you. All right, so what's driving markets now? What's on our minds? Other than Harry Markowitz and his contributions, I think AI is something that's very much on people's minds. And I want to put this in the context of what AI can and can't do for financial markets. So computers are great extrapolators. AI, this generative type of pictures and chats that we've been seeing are amazing proof of that. And I think that at some day they'll be able to, do things that are like make a whole TV episode from just looking at the first scene or taking a little piece of just about anything and doing amazing things with it. But think about how much financial information there is and how little you can do with it, right? You can take a little piece of almost anything and generate a huge output with an AI. And it looks good. But you can take every bit of financial data going back 100 years, and you still wouldn't have much insight into just what's going to happen tomorrow. So there's a huge discrepancy between a little bit of start information and a lot of extrapolation versus financial markets where you can't do that. So efficient markets mean that technology is unlikely to be able to extrapolate. And the technology and information, on the other hand, improve market efficiency. So what may happen is you may have AI-enhanced modeling and forecasting, but that's only going to make the market more efficient. So thinking about what AI does well and what doesn't, there are many things out there like better Google searches or dinner recommendations that are perfectly benign and potentially very helpful. What's exciting to me as more of an economist is thinking about what it can do in terms of enhancing productivity, in terms of thinking about doctors, lawyers, programmers, and financial professionals, among many others, who are going to be able to use enhanced technology to be much better at their jobs. In terms of replacing all people, I hope that doesn't happen, and that could be risky. So some of these things you have to be careful with. Now, what's really benefiting? My view is that the whole world is really benefiting, is that we have seen a very small handful of stocks get the majority of the enthusiasm from these new technologies. This is something that happens a lot, and whenever there's any sort of innovation, and then eventually the market realizes just how pervasive an idea can be. And most of the sort of true value of something like AI seems like it could be the type of fundamental productivity enhancer that could work its way out in just about any sector of the market. So we don't know what the future will be, but I think it's a good bet that it won't happen just as expected and just at the time frame that we're expecting. And so my conclusion from that is don't make concentrated bets. NVIDIA is not going to be the only beneficiary of this new technology. You're going to have Home Depot with something to help you at the end of every aisle and all sorts of other things like that we are starting to see now. Another is just be careful of how you're investing in terms of, and just to take a quick example, look over the last year, this just year to date, of 3 different growth indices with substantially different returns based on how the index was weighted. Fortunately, we have been using the top two in this list, but it's important to think that indices aren't perfect. They weren't anticipating this, of course, and so they will not capture information in the same way. So switching over to bonds. Bonds are the other, of course, big thing that has been changing. The Fed has continued to raise interest rates after a short pause. I think with inflation a little lower, people are more optimistic, but interest rate volatility is clearly lower than it was a year ago. If you actually look at the MOVE index, it is not as low as you might expect, but that's just short-term volatility, which you can largely explain as short-term volatility being largely driven by the Fed, which probably we know what's going to happen, but definitely we know that certain things are going to happen with the Fed. And so that just makes at least certain parts of the fixed income market a little more volatile in the short term. As far as over the longer term, we want to understand that a year ago, interest rates were about 4% lower than what they were now, 400 basis points about a year ago in terms of what the short-term interest rates were. And conventional economic wisdom is that it takes 12 months, maybe even 24 months for the effects of new macro type of intervention to affect actually the economy. So we are just now at the 12-month of just starting to get up the curve. So much of this hasn't happened yet is the point here. So when you're thinking about bond risk, hopefully most of these changes are going to take place. There are definitely risks associated with that, but yields are much higher. And I really want to point out from this graph, real yields are much higher. We spent most of the last few years with negative real yields. And now we have some of the more positive real yields that we've had in a decade or so. So real yields are quite high even by historical standards. And so that gives a cushion that if there is some volatility and bond prices don't go in the direction that you'd hope because of some surprise change in interest rates, then bond investors should still be okay. Not great, but okay. So it is certainly much nicer to have a cushion. Last time I also pointed out that higher yields mean you're getting more of your income sooner. So that means less duration of fixed income and less sensitivity to interest rates, even for longer term securities. On the market side, there's a lot of concentration on stocks. I don't want to bore you with the same story. We've all know what stocks these are. And this is very directly related to exuberance about the new technology. And this has made me question some of this optimism, whether the recession is still priced into markets. In the fall, I was very convinced that the recession was priced into markets, so that even if now-ish a recession did start to play out, that stock prices wouldn't be hurt too much. Now that there's more optimism, it's no longer clear that that's the case. If we do indeed have a recession, how that will work out for US or international stocks. My personal theory, which I unfortunately don't see very much in the data, is that some of this optimism about the long-term future and technology is offsetting some of the near-term pessimism of the economy still is going to slow down a little bit. And those two things are canceling each other out to some extent. And so we're seeing a net small optimism. Now, why the other part of optimism that's more real is inflation has indeed lowered. This is getting close to the Fed's target rate of 2%. It's not just a US phenomenon, which is quite important. It's been happening all over the world. Interestingly, China is doing its own thing and is actually getting close to deflation. So why this is so important is that it has finally allowed the markets and the Fed to be more or less in agreement. So the dots that you see are the Fed's dot plot. That is the little stickers that every member of the Fed gets to put on the board and say where they think rates will be at the end of this year, the next year, and in the long term. And the blue line is just the median of those. The green line is a completely different data source in that the green line is the market's implied interest rates at various points in time. And I believe I've showed this picture in the past, and it was wildly divergent. What you see here is that more or less it's an agreement. In fact, this is, as far as markets and the Fed goes, this is very much an agreement. And so this is another good reason to think that there won't be a huge amount of volatility in either fixed income or equity markets going forward. Famous last words, all sorts of stuff can happen, but at least the problem isn't going to be that it's because bond markets and the Fed just could not agree on which way interest rates were going. So now that I'm saying it, I'm getting nervous that things are feeling a little bit too good. So how do we add up the news? I think there were some things that happened when we look back that were fairly expected and didn't have a very big impact. So the debt ceiling is, I would say, the greatest example of this. A couple months ago, that's all we could talk about, and now it's completely out of mind. And I don't think it matters at all going forward, except that we might end up, in fact, probably will end up, in another situation like this at some point down the road. The Fed rate hikes have more or less been happening as predicted, and the only problem is each time they notch up interest rates, that makes us one step closer to a more likely recession, even while it's making it more likely that inflation really will come down. The bank failures, my personal opinion is that, which again I shouldn't do, but my personal opinion is that I was a little bit surprised that there wasn't more of a reaction, there wasn't more flight going from obviously low interest paying banks to obviously much higher short-term treasuries or money market funds. And so it seems like that has definitely died down, so there's less risk there. Now, China slowing down, I think, was a surprise to a lot of people. They thought that it would come out of the post-COVID period, opening up, and have a lot of pent-up demand, and that doesn't seem to have materialized. And so China being hot has some advantages for growing the global economy, providing cheap products that will lessen inflationary concerns. But then again, it also absorbs a lot of resources and works in the other direction. So it's a little bit mixed there. And but AI, a surprising event. And as I said, long term, what really progresses the economy and all of society forward is technological change and productivity enhancements. And so from that perspective, it's very positive. So in ETF news, there's been a lot of talk about active ETFs. Active ETFs are a relatively small part of the ETF market. They used to be all there was in the market, right? All investing used to essentially be active investing until people realized that passive investing actually could deliver far better performance with less costs and more transparency and less taxes, and it was great. But active investing is a necessary part of the market mechanism, and it will probably always be here. And so why not have active investing done through an ETF wrapper? Bitcoin was also given a boost in terms of BlackRock and other high credibility ETF issuers applying for a actual spot-based, not a futures-based ETF, which would give it some legitimacy, and actually is the thing that I think a lot of institutional investors would require for investing in Bitcoin, a transparent, liquid way that they can invest. ESG enthusiasm, on the other hand, has really waned with fund companies. So what do I want to leave you with for the quarter, which is, I think we all were glad that we didn't panic about the various things that happened. This was another great case of banking failures, recession fears, and the debt ceiling sounded very scary, but they shouldn't keep investors out of the market. I remember talking a year ago about a lot of investors who were on the edge after a couple of really rough quarters. And I think all of those investors now are quite happy that they managed to stay in the market for a year. Right? This is a familiar story. AI is not something that you should try to just bet on a couple of stocks to get. Wait for it. It will affect the broad economy and in unpredictable ways. And a diversified portfolio should be able to capture that. And finally, let's all try to learn from Markowitz. Let's appreciate his contributions. Let's try to get a deeper understanding of the broad benefits of optimization, but really how you have to work hard and really think in a very big, complete picture sense to get the greatest benefits of optimization. So I think we are now ready for Q&A.
All right. Thank you, everybody, for your participation throughout the webinar. We've been gathering a lot of great questions throughout the program, so let's get started. And please keep in mind, if we don't get a chance to get to your question, we'll reach out to you directly afterwards. So our first question is about performance. Joy, can you explain how you allocate to growth?
Yeah, sure. And I kind of mentioned earlier in my section as well about growth. So the way we think about value growth in our portfolios is that we do not think of them as factors that are seeking higher premiums, but as risk exposure that we can effectively segment US markets into large value, large growth, small value, small growth. And they have very different risk return characteristics, looking at long-term historical data perspective. Large value relatively has the lowest risk, and small growth has the highest risk from a historical perspective. So when we optimize portfolio along the efficient frontier for different risk target, naturally, right, the aggressive portfolio should have proportionally more aggressive assets, including large growth and small growth. So if we look at the allocation, so even though our global all equity profile doesn't have an overweight in large cap growth, it has an overweight in growth overall, including large cap growth and small cap growth. And also, if you look at the conservative portfolios, it has a value tilt to provide that diversification. And for 60-40, a more balanced portfolio, it has balanced exposure to value and growth. And the reason we're doing this, that we want to make sure that portfolios have their defined risk that's in line with the target risk, and they can have more smooth performance along time when value growth rotate. And I think the other perspective to that question is, can you time value growth rotation effectively and thereupon adjust exposure based on your bets? And I think the answer is no, and it's very unreliable. And we're not trying to do that for our portfolios.
Right. So again, it comes down to optimization. Value has certain characteristics that are more beneficial to more conservative investors, and growth tends to be better for the most aggressive investors. And unfortunately, for the luck of this most recent performance, I think we had a little bit more of a tilt to small cap growth rather than large cap growth that would have been optimal in hindsight.
All right, so moving on to our second question. This question asks, what New Frontier is doing to combat the erosion of purchasing power from long-term inflation in the models?
Sure, I can answer that. First of all, you can think back a year ago when this was a really serious question. I thought of this as the conservative investor's dilemma, which was inflation was so high, interest rates were so low. If you were conservative, you were definitely going to lose purchasing power in your portfolio and have inflation eat it away. So there wasn't a right answer back then. Either you took a lot of risk and maybe you beat inflation, maybe not, or you didn't take risk and you definitely lose to inflation. So that's an efficient frontier where all of the choices are bad for you. Now we are in an efficient frontier where hopefully choices are much better for you. So if you are conservative, then you saw from the real yields that you can actually beat inflation with very little risk. And so if you look at something like short-term treasury bonds or money market funds are offering. They're offering something. Getting short-term treasury bonds would be my choice, but they are offering something above 5% interest, and we just saw that inflation is currently down to 3%. So that's beating inflation. We also have a certain number of real assets in the portfolio, which are there in large part for inflationary risk reasons, things like real estate and gold. And then, of course, equities are always something of an inflation hedge, right? They can earn money in nominal dollars and profits in nominal dollars, and they can raise prices as inflation goes up.
Great. Okay, so moving on, over the last year, there's been a lot of news about fixed income. So we're going to touch on a few questions regarding that topic. So first, what's the most compelling part about the yield of the yield curve to be investing during the next 24 months? And secondly, what kinds of bonds do you favor? Please be specific in quality and duration.
Let me see if do you want to say something quick, Joy?
No, go ahead, Robert.
Okay, so first of all, I want to flip a few slides back to this, where one interpretation of the difference between the Fed's blue prediction line and the green market line is if the Fed actually does what it says, then at least for the short term, markets are under predicting interest rates, which means that the short end of the curve is better, or is going to pay off more over the next year or so. And from my perspective, I don't want to bet on that, but I know that the short end of the curve is much less risky for the portfolio. And so if I'm not expecting return and taking risk, I don't want to do that. Optimization, right? So from my perspective, having a hefty allocation to short treasuries is intuitively optimal. And indeed, that's what our optimizer will choose. Interestingly, you can see all the way at the end of this curve that the market is expecting somewhat higher rates than the Fed. And so that might mean that there is actually some kind of duration premium over longer periods of time. So at some point, we will rethink and we will change the way we're allocating in our portfolio as new information arrives. But for now, the best risk to return trade-off is getting a lot of return and almost no risk, and thinking about getting risk and taking and getting return in other parts of the portfolio.
Yeah, I agree. I think my answer will be one of what your slides suggest, investing in an inverted yield curve, and you do want to take advantage of 5.2% yield on the short end right now.
Okay, so our next question is regarding non-qualified tax-favored income choices. Considering taxes, what are the preferred tax-favored income choices?
So I love this question because it plays into today's theme of optimization, which is really every day's theme, which is the intuitive answer is tax-sensitive portfolios should only be investing in municipal bonds. The optimized answer is that it depends, and you should be optimally allocating to taxable and tax-sensitive bonds. Obviously, municipal bonds have a huge advantage, but they have some risk associated with them, and you need to look at what markets are currently offering you. Currently, we're talking about Treasury floating rate notes that keep coming up. Those are offering 5.2% yield right now. If you take even the highest tax rate, because they don't have any state taxes, that's 40.8%. If you take those numbers, you're still comfortably above a 3% yield from something that still has no risk associated with it. So clearly, those will still have a place in a tax-sensitive portfolio. So looking sort of across the spectrum, you're going to see opportunities like this. Usually things like high yield, though, have so much taxable yield and actually have expected capital depreciation that they don't make a lot of sense for tax-sensitive investors.
Okay, and next we'd like to touch briefly on the topic of recession. Robert, do you mind sharing your current thoughts regarding the status of a recession?
Well, I don't have too much more to say than what I already said in terms of, I think there's definitely a risk. We haven't seen the full impact of the Fed policy come into play yet. It takes about a year, and a year ago, interest rates were still low. Internationally and in less developed markets, it takes conventionally wisdom from economists is even longer. And so there's a lot that hasn't happened yet. And so that's risky. And just intuitively, a lot of the world needs to slow down a little bit to put less pressure on inflation. And whether central banks go through with it, maintain the resolve, that's another open question. So there's some risk, and then there's also optimism about the future that's tempering that.
Great, and we have time for one more question. Will Bitcoin and similar assets ever be included in your portfolios?
Oh, go.
So I want to add that, Robert talked about Bitcoin ETF development, and even if we have a real spot-based, Bitcoin ETF available in the near future, it's important to remember that Bitcoin itself is still a very highly speculative asset, and it is true that it might have low correlation to other assets because it's highly risky and volatile. But will that bring risk-adjusted return benefit to the portfolio is a different question, and that still needs to be vetted and tested.
Right. So having a good quality spot Bitcoin ETF would be a requirement. But also remember, we were one of the first institutional investors to strategically allocate to gold. You had to have a new way of thinking about it, modeling it, and including it into a portfolio in an optimized way to be able to use a new asset class like that that was newly available. So the gold ETF did that. And then and a Bitcoin ETF at least opens that possibility. But yeah, there's a lot of work to do before we can confidently say that this is going to add risk-adjusted return and make your portfolio more optimal.
Okay, and with that, thank you everybody for joining us and submitting so many great questions. As always, it was great to hear insights from Robert and Joy. To finish off today's program, please remember to take the brief survey before you go. If you have any questions, please don't hesitate to reach out to our team. And we also want to announce that our Q3 Market Perspectives webinar will take place on October 19th at 1 p.m. Thanks again for joining, and please enjoy the rest of your day.
Thank you.
Thank you.